Yields on the 10-year sliding now after crossing 5% earlier this morning, almost back to 4.85. How have higher rates impacted the tech sector in particular? Deirdre Bosa is digging into that ahead of this big week of earnings for tech this morning on Tech Check. Hey, Dee.
Hey, good morning, Carl. So higher yields, they are hitting the tech complex in very different ways. There's mega cap tech at one end of the spectrum. They look safer, more defensive in this environment. There are more mature businesses, but they're still GARPy, growth at a reasonable price. On the very other end of the spectrum are startups. These are tech companies that are still building. They're focusing on growth, and they're pushing profitability out to later when their business scales. The problem with that, though, is that rising yields makes that business model incredibly unattractive. Valuations come down because the current value of those future cash flows is worth less when rates are higher. And at the same time, their borrowing costs are increasing. So a double whammy that is leading to more startups just shutting down. Carta is the company that helps startups and VCs manage equity or cap table related activities. And it found that nearly 550 startups have closed shop this year, more than the 467 for all of last year, and concludes that this has already been the most difficult year for early stage companies in at least a decade. Rising rates, the 10-year yield hitting 5%. That will only amplify those challenges. You can see in this chart that the pace of closures spiked in the third quarter. One high-profile name to go under recently was Bezos-backed Convoy. It's a trucking startup that raised $260 million at a $3.8 billion valuation just 18 months ago. It was expected to surpass $1 billion in annual revenue. Even round after round of layoffs could not save this company, and its failure has raised fears that the wave of closures could only be starting. Avlok Kohli, CEO of AngelList, that's another platform for startups and VC funding, he's seeing similar data, and he tells me that it could get worse before it gets better. A major exception, of course, that we have talked a lot about are generative AI startups, but even those could garner a second look as yields rise. Now, of course, the picture could not be more different at the already established cash flow generating mega caps. Apple, it's sitting on $167 billion in cash and investments as of last quarter. Alphabet, $150 billion. Microsoft, $120 billion. Now, if that cash is yielding 4% at a minimum in the relatively risk-free treasury market, that's now nearly $7 billion coming in the door at Apple annually before it sells a single iPhone. What we could see, though, guys, is more calls to distribute that cash to shareholders. And this upcoming earnings season is going to be critical in terms of buybacks and dividends.
Wonder if we'll also see some of those companies with the big cash and the big cushions take advantage of what we're seeing with smaller companies, either the unprofitable public ones or as the startups, as you say, to buy.
Yeah, and maybe a regulatory environment that doesn't look as scary as it did a few months ago with some of the developments like Microsoft, Activision, Blizzard getting that through. Certainly that appetite could be rising. But again, the standards, the bar is getting higher, right? If you can earn at a minimum of 4% in the relatively risk-free treasury market versus betting on one of these cash-losing startups, that changes the calculus a little bit. And that was interesting. I gave you the example of Convoy, this trucking company that went under. In the CEO's letter to its staff, he said that a lot of the strategic options just fell apart in recent months. They were talking to different companies about kind of an acquisition, but it just doesn't look as attractive in this environment. So it's got to be, the reasons have got to be there. And like I said, there's kind of an exception in the generative AI space, and that's really where you're seeing all the deals and the capital being raised at the moment.